Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, March the 4th. I'm Eric Wilkinson, and yes, you very well may recognize me from mainstream media where I talk about economic and geopolitical environments and then how that is overall impacting the markets. I also do that in these daily market commentaries, but I layer on top of it option strategies that you can implement into your portfolio in your own way. I'm going to talk about how I implement those. I talk about specific rules, dates, time, or days to expirations, I should say, strikes, and the environment in and around those underlyings in order to implement the right strategy for those different aspects of that underlying. And it's pretty specific, so we can follow these specific rules and then implement the right option strategy for that market directional assumption that we come up with based on the economic geopolitical environment, all right, and our market analysis. All right, without further ado, let's talk about some economic data. We got across the pond some PMI numbers, which is Purchasing Managers Index. That is forward looking. Now, keep in mind, though, these PMI numbers are pretty much before what happened with coronavirus and all of that kind of coming out right now. So some of that is not really going to be showing up in these data points. So everything, all these economic data points are kind of out the window right now. It's really about news-driven events at this point. So across the pond, let's just say they basically came out above 50, and anything above 50 is showing expansion in the economy. So all of the PMI numbers across the pond were above 50, so that is a good thing. Not all of them came in exactly in line with expectations, but for the most part, they are pretty close for government work. Great Britain's PMI did as well. Then we got European retail sales in line with expectations at 0.6%. Now, keep in mind, that number is before all of this hubbub came out. All right, ADP non-farm payroll. This comes out before the real number on Friday, which is our non-farm payroll. It's been getting better in the past. We haven't really looked at it that much, but it is something to keep an eye on. And it came in at 183,000 hires, expected to be 170, so better than expected on that front. They did revise last month's number down quite dramatically from 291,000 to 209,000. So that was a big revision to the downside, and it was expected to come out last month at around 151. So the revision put it down below the expectation of what we ended up getting. So 251 was the expected. We got a result of 291. That just knocked it out of the park. Now that revision is back down at 209,000. Just a huge revision to that number there. But again, we will keep in mind that that isn't the one that we're really looking forward to. That's Friday's economic data point. And then here in the United States, we got the Institute for Supply Management, or the ISM, non-manufacturing, which just means service sector. PMI coming in at 57.3, much better than the expected 54.9. Crude oil inventories came in at a build of 800,000 barrels, expected to be 2.8 million barrels. So not quite as much as what was expected. That means supply is coming off. Demand obviously expected to be increasing there with that whole switch in the paradigm. That's giving a little bit of a lift to crude oil. Not enough to get it back above 50, but enough to give it a little bit of buoyancy here, up about 60. It's also making a move based on equities, moving a little bit higher today after yesterday's massive sell-off. I mean, we're talking volatility of 1,000-point swings in the last few days. That is pretty unheard of, to be, for lack of a better thing to talk about. All right, we've got gold futures slightly in positive territory. They're trying to make a move despite the fact that we're seeing equities move higher. 10-year Treasury, I don't usually throw up this right here, but what this is signaling is that interest rates are below 1%, you guys. That is a major historical implication there. It makes it look like we are looking at negative rates here in the United States, and that is not a good thing. We can see that in Japan and other places where they've gone into negative rates. they can't get away from that. So that is really extremely low. If you haven't refinanced your home, this would be the time to be refinancing. And if you have been looking for a home, now is probably a good time to look at buying a home for sure. So we've got the 10-year up on the day, as you can see there. Bonds are up on the day, almost a full point there. 29 ticks, 32. Remember, 32 ticks is evens. So that is a full point in the bonds. All right, VIX is off by about 2.5%, almost 3%. Or 3 points, I should say. But it is in the 30s. So we're still seeing elevated volatility in most of the equities across the board. If you watch my daily market commentaries, I talk about implied volatility percent, and that's basically a judge of each underlying's implied volatility versus where it's been in the past. And all of those are really at 100% still based on where they have been in the past after this little spike we've gotten. So, with our volatility, it's kind of following along with the volatility we're seeing here in the VIX. But, if we were thinking that this is the volatility or implied volatility of an underlying, you can still see that at these levels, anywhere above here, and we can pull up a couple of charts on other things, all of these levels are well above where we've been in the past. So extreme high volatility happening across the board there in the VIX. And then, and that's affecting the underlyings as well. All right, we've got the Dow Jones Industrial Average off of the highs. We were up almost, I would say close to 700-800 points at one point. Up 500 points on the day. Just massive moves, as you can see there. Even in the VIX, up 146 points. The NASDAQ up 148, 150 points on the day. Halfway retracing yesterday's losses for the most part. And we are building momentum, what it feels like, going into the end of the day. We can see that the MACD here is coming off of those extreme areas. I think it's just extremely oversold, and we're starting to see some volatility, implied volatility coming out. This is kind of what I was talking about with that implied volatility area. Can I move this thing without messing everything up? If we look at implied volatility as the highs kind of here, let's see if I can draw a line here, throw a line out there. You can see that, that's been the extreme highs for implied volatility. So what I'm saying is we are still above massive spikes that we've seen in implied volatility down here at these levels. So, that's what I was saying. You could almost say that it's still at 100%, despite the fact that we've gotten this little spike there. That's really the quote unquote, when we do the math, 100% there, but still extremely high volatility across the board in most of the equities. This spike right here is an anomaly that probably shouldn't be there, and it's flatlining my implied volatility marker there. But again, E-mini S&Ps up about 42 points on the day, taking back about half of yesterday's loss. At one point, we had taken back all of yesterday's losses. That was in the overnight session. Here we can see overnight, that's that big sell-off I was talking about at the end of the day. Just a lot of profit taking going on, as I think that retailers came in late in the day and had a bit of a panic selling based on what the FOMC did yesterday. Remember, they had a emergency rate cut. A lot of people were saying that was a good thing, try and make money a little bit easier. Well, I think that they kind of shot off a couple of bullets, are going to put themselves into a corner. I think tax breaks would have been better, despite, we can't really do a tax break that'll help people this year, but increasing that money flow from people and increase that velocity of money is really where we should be looking, not lowering necessarily interest rates. That helps out the big businesses a little bit more. A little bit of trickle down that way, but the real trickle down would be through giving the average person more money in their pockets, and that would come from usually tax breaks there. The easiest way, we can talk about wage inflation, things of that nature, but when you're looking at a looming possible recession based on a pandemic, then that's not going to help. Because those guys are going to be looking at holding back on hiring because they think there's an imminent slowdown. Anyway, enough about that. We've got the E-mini S&Ps moving higher despite the fact that we are near the lows of the open market session, the day session. I do expect this market to want to pick up a little bit of momentum going throughout the day, as you can see there. And that's about it. I haven't added or subtracted anything to my portfolio. I'm just keeping an eye on it right now. After yesterday's sell-off, wasn't too happy with that, but I think that they threw some panic in there, gave opportunity to some people. I'm pretty much allocated already. I do have some available dollars in there, a little bit of dry powder that I can start adding, but I'm going to wait for great opportunities at this point. So let some of these other ones work out, like Gilead, that's doing well. Delta Airlines isn't my friend these days. We can probably take a look at Delta. It's going to continue to slide off. I've got very small allocation to this, and I'm continuously staying mechanical with this. If you guys remember, I'm long this at about 60, which is way up here. And what I've done is I've started selling some calls. So I'm starting to sell calls in this to lower my basis on this. So I'm trying to lower my cost basis on this. So continuously lower what I ended up paying for this. And that's how I'm going to continue to play this. As you can see, again, with this line in the sand, we're going to have to keep an eye on this because you can see that where we've been, even for earnings and things of that nature, Delta Airlines has not seen implied volatility of around 67, and that's probably twice as high as it normally is. So that being said, again, that's what I'm talking about. This whole move here, this whole move there is based on, it is at still, in a sense, 100% of where it's been. It's, just last couple of days, we've gotten that high spike, but still extremely high implied volatility, which is why when we're trading down at these levels, I'm able to sell the 60 calls, all right, at the 60 strikes. So the market is pricing in massive moves with the VIX up near 40s. That's like a 3% daily move in the underlying. So we're seeing those kind of pricing getting put into things like travel and entertainment because people are expected to pull back on it. O'Hare was almost empty yesterday. So a lot of people coming into this spring break season, keep in mind that that's a big travel area, right? People are canceling their travel plans based on the coronavirus, and that is going to cut back on a lot of velocity of money, to be honest. All right, so keep that in mind. Like I said, I've got everything else working. Tomorrow's webinar, we're going to be doing that on the collar, all right? And that is been made famous by Mark Cuban when he sold broadband.com to Yahoo. He put on a collar around his Yahoo stock. He wasn't allowed to sell it or didn't want to sell it, but putting on this collar locked him in. So if there was a massive move down, then he could take profits there and he could have that stock called away from him. In this case, something like Delta, that would be a perfect scenario. I mean, if I could get out way up here above the value area, that would be a massive V-shaped recovery that I don't think is going to happen in Delta. But if I'm worried about some more downside in this and really see people pulling back, I might want to be able to exit my Delta Airlines. And I'm going to talk about how we're going to build out that strategy so that we can take advantage of locking in an underlying where it currently is, in a sense. Okay, so follow that. Go to protraderstrategies.com. Check that webinar out because it is a really good one, you guys. I can't emphasize enough this webinar course that we're doing right now is absolutely one of the best timings that we've had for doing courses and things of that nature, because this is implementing options into your portfolio in order to build that out. And right now, I believe that if you have money on the side, it is the time to really consider adding stuff to your portfolio, despite the fact that we're seeing a lot of volatility. That is my opinion. That is not investment advice. We do not give investment advice here. We are an educational company. I can only tell you what I'm thinking I would do for myself, and it's up to you guys to make your own decisions moving forward. So keep in mind, we are an educational company, and past performance of any trading system or methodology is not necessarily indicative of future results. So please take a moment, pause the video here, and read over this disclaimer as it talks about more detail as to how this is not investment advice, and there is a lot of risk out there right now, so you could lose money. All right, that's it. That's all I got for you guys, other than if you can't take that, take it easy.